Well, good morning. Megan and I were discussing before joining whether or not we're in a recession. She thinks we're already in one, and I'm thinking we're not. But interestingly, we've never not had a recession when we've had 2 quarters of negative GDP, but we've never had a recession when we had positive job growth and consumer spending like we had in the first quarter. So we really are breaking the rules, either whoever wins, right? So it is a very interesting time. Of course, inventory is the headlines right now. Megan's going to be jumping into that on a local level. I'm going to talk about it for a brief second on a national level and jump into some of the economics that's happening as well as some good news for first-time home buyers. So we're going to get into all of that. Start out with my quote, hand it off to Megan. We'll circle back to the economics, and then we'll let you guys have an incredible rest of your weekend. It's supposed to be what, 95 degrees this weekend?
95. It's supposed to be almost 100.
And no
rain.
And no rain.
I was thinking about taking the kids to Waterworld, but I was like, is that too much of a task? Like single momming it?
Momming
I don't
it
know.
95
two
degrees.
Little kids on a hot weekend at Waterworld. I don't know.
Do you think like most of Denver's having that same thought right
now?
They
probably are, and it'll be a zoo. It'll be a total zoo.
So here's our quote. It's from Jim Rohn, and I used it when Megan and I did a one-off real estate office presentation. Had a lot of fun with that, but wanted to replay this because it really seems apropos given the time. This is a really intense, very news headline driven time of, or a season, right? So what are home buyers thinking right now? What are home sellers thinking right now? They're watching what their neighbor did a month ago, and that's not happening for them. So who's making sense of this for them? And here's the quote from Jim Rohn: "Don't let your learning lead to knowledge, let your learning lead to action." How are you continuing to communicate and to educate and to create calm where there is fear? That's our job on a regular basis, isn't it? Let the data lead.
Facts, not fear.
Yes. Yes. Let the data lead. So with that, I can't imagine a more excellent introduction. Let the data lead.
Let's do this. Let's do this. So I went through and crunched through all of the numbers. This is going over Independence Day weekend. And as you know, we end up taking a little bit of a dip as we go through Independence Day weekend. What was nice though, is that if buyers who had been beat out earlier in the year, they had a nice reprieve this last weekend where they could be in less than a competitive market going into Independence Day weekend. And there were some deals to be had.
Yes.
We ended up seeing a lot of price reductions. We ended up seeing homes going for under asking price. I'm still working through all of the numbers for the month of June. It's going to take me a little bit of time. I'm waiting for some data points to come back that talk about interest rates and affordability before I can get out those reports. So look for that later today or probably tomorrow when I can get those reports out to you. It's also time for me to turn over my appreciation maps.
Yes.
So that we have the half yearly report for appreciation by zip code. So I'll be working on getting that out to you guys
you got some work to
this
do
weekend. I do.
By the pool?
I know. Well,
okay.
We'll see. It might be a little bit too
I think
hot.
The computer's gonna eat up.
I have a 4-year-old that thinks he can swim, but he's still a little bit shaky. So I've got to sit on the edge of the pool. I'm not about to take my laptop over to the side of the pool and sit and work. And plus it gets a little bit hot. I sat outside and worked for about 2 hours yesterday, got cooked on my back. And so it was only like 78 degrees yesterday and still managed to get cooked. So let's go ahead and hop into the numbers and get everything going. Screen two.
Yeah, you just don't have it on presentation. Yep.
All right. And so looking at all of our numbers that go through June 29th through July 5th, again, this encompasses over Independence Day weekend. Hope that you guys all had a wonderful and safe, happy 4th of July. Our next 3-day weekend coming up is going to be Labor Day weekend, and we expect to see similar dips as we go through that next set of our market. But as you can see, we ended up having some blue cells come in here, but it ended up lightening up a little bit because there were fewer new listings that made their way to market. So our inflow of new listing activity actually declined declined by about half. And so you can see that our new listing count, we only put up 918 new listings, whereas we typically put up about 1,800 new listings each week going into the summer months for July. But our new listing inventory went down by about 50%, which is a good thing because we want you to stave off on those holiday weekends because there's a definite dip in what happens. But our average daily active count, we're now sitting at about 5,500 active units, and we haven't been that high since we were in pandemic levels. And so again, we've seen a big jump in our inventory, and a lot of inventory is hanging out for an extra weekend or two. So it's time for you to set those appropriate seller expectations that you might not be under contract that first weekend.
Right.
And so again, taking some time to go through and really make that home show ready, because there are a lot of buyers out there that are getting more picky because of the psychology of going through earlier this year and getting beat out on so many transactions earlier this year, that now that they've watched home prices skyrocket and now that interest rates are higher, their affordability is not the same. And so they're getting more picky about what they want to purchase. And so it's important that you're getting your homes show ready. Our month supply of inventory is now at 1.3 months worth of inventory. And again, that's over a holiday weekend. That increased by 0.4 months worth of inventory over Independence Day weekend. So again, it was a much less competitive market environment. And that's out of multiple offer territory for that particular weekend. And so again, with 1.3 months worth of inventory, that means for every one buyer in the market, they have 1.3 homes to choose from. And we haven't seen over one since we were back here in December of 2020. And so it's been a long time since we've been over 1 month worth of inventory. Going into next weekend, I expect that number to dip back down to about 1 month worth of inventory, but it was a nice weekend for you to take your buyers out. Not a great weekend to list a home, but again, a great weekend to take your buyers out if you were going to get them under contract. Pending transactions this week fell by about 23.1%. So again, a nice little dip in buyer activity over that 3-day holiday weekend. Hopefully, if you had your buyers out, you enjoyed some additional negotiating power as you put those buyers under contract. Back on markets fell by about 35.6%. So we ended up seeing fewer homes come back on market as we went through this holiday weekend. People are probably waiting, if it fell out of contract, to put it back on the market this weekend. So we might see a jump in back on markets going into next weekend. The odds of selling takes a really big dip over these 3-day holiday weekends. It dropped down to 58.1%. I expect there to be some slight rebounding in that number because Independence Day weekend is one of our major summer holidays where it really takes a dip in our buyer activity. And so again, the odds of selling dropped down to 58.1%. That number is likely to pop back up to about 60% when we go back into this next weekend. But again, that's below where we were pre-pandemic levels before we went into COVID-19. And so those odds of selling are starting to drop. I've had a lot of questions about, should I wait to list my home into the fall?
Right.
And I would say, no, you want to list it as soon as possible because our buyer activity really tapers off starting in September when kids go back to school. There are more reload deals that are happening where people are being relocated at the higher end of the market. But again, we end up seeing a big dip in that buyer activity as we go into the later part of the year. I could almost set my watch to this market for the last 9 years in a row. This year was a little bit different, but right after Independence Day weekend, there's a big drop off in showings. There's a big drop off in open house activity. And so again, we can expect the market to become less competitive as our summer months go on and as the weather continues to heat up.
So as a listing agent, I've actually had this conversation with a couple of real estate agents that I'm good friends with, talking about the additional work that they're having to do compared to the last 2 years, right? It's that having to go back to 2019. What did it look like to stage a home, to actually get presentation materials done, to spend the time, money, and energy in having that home ready and listed, right?
Right. I'm seeing a lot of people go back to just listed cards. And so now that homes are spending more than 1 week on the market, that's a great idea, is to go through and do a just listed card. We can always help you out with those at First American Title, but it's always a good idea to send that out to the closest 200 homes around that house that you got listed, or out to your spheres for production, but you want to get the word out that you've just listed a home in that neighborhood.
And of course, open houses are right back on fire.
Right back on fire.
So many of those. And two, our team is doing open houses with some of our agents. We only have so many people and so many hours, but at the same time, if you guys want some help and you want one of our team members to join you for an open house, let me know about that. But yeah, they're having to get back to business of 2019.
Yes, definitely. And that was definitely what we saw. There was a dip of activity back in 2019 when interest rates went up to 4.5. Now they're at 5.5.
Yes.
Yes,
we're-
they're at
yeah,
5.5. So
yeah.
again, there's some extra work that you have to put in as a listing agent in order to get that home ready for market. You've got to try a little bit harder than what we had to do back in January and February. Now, the percent of balance ended up jumping up to 21.9% of balance. We would need to have about 25,000 homes on the market for sale based off of what went under contract this last weekend. Again, we only have about 5,500 active units available for sale. I'm still not concerned about a market correction, but we are watching our inventory stack up and it's trending towards a more balanced market in a very slow way. That number is going to pop back down after this next weekend when buyers start to get out again after July 4th. But again, 3 conditions need to exist in order for a bubble to burst. We need to have an oversupply of homes, which we don't currently have.
No,
You need to have a lack of equity in the market,
which we don't have.
which we don't have.
No.
People have been experiencing near double-digit appreciation for about
Yes.
10 years in a row now. So again, people, if they find themselves in a level of distress, they're able to list that home very quickly for sale, get it under contract and walk away with that equity, which is unlike what we saw back in 2008. And then we need to have some sort of economic widespread hardship that leads to a large loss of jobs. We're not currently experiencing that. Unemployment rates right now are at what?
3.6.
3.6. I was
Yep.
going to say 3.5, but 3.6% right now. And so again, we're still short on we're still short on employment and labor right now. So people are able to get jobs. So we're not concerned about a correction happening in our market, even if we do go into a recession, which has been a large amount of talking that we've been going through.
Right.
Out of the last 9 recessions, and only 2 of them did we lose housing value. Typically recessions are good for real estate. And so again, we'll still experience appreciation going into next year. I've got a lot of people holding my feet to the fire, trying to predict what's going to happen next year. And it's just too soon to try and predict what's going to happen next year.
Yeah.
But right now our appreciation is still, our year over year average sales price growth is still bouncing between 13 to 15% year over year
Yes.
for average sales prices being up when I pull the numbers through the end of June. Showings this last weekend really dipped off. So if you put up a new showing this last weekend, you could have expected about 2 shows per weekend on that property. So again, not a big weekend for buyer activity going into Independence Day weekend. And it was about 10.4 showings should have yielded you an offer. So again, your home could sit on the market for about 5 weeks before you go under contract. So again, I'm advising people to wait a little bit longer before making price reductions. You want to make sure that you get enough people through that house and enough feedback before you go through and make those price reductions. Unlike back what we were experiencing in January and February, where if you weren't under contract in the first weekend, you weren't in the sweet spot in your market. And so right now we're pricing off peak by about 5 to 7% from where we were back in January and February. So if you're looking at comps back from January, February, March, and April, you've really got to pull back about 5 to 7%. And we're seeing price reductions on the same realm where you really have to ease up in your pricing strategy going into the later part of the summer months. And that's all due to that relationship shift between supply and demand. Supply is way up from where we were back in January and February. We've got roughly 5 times the amount of inventory, and our buyer activity has dropped by about a third. And so we've got a significantly fewer buyers in the market now than we did back in January and February. A lot of our demand was absorbed earlier this year when interest rates started going up. It forced a lot of buyers into the market early, making their purchase in January, February, and March, rather than waiting until March, April, May, and June to make their home purchase. So we've seen significantly less buyer activity. Median days on market popped way up. We ended up coming up to 11 median days on market. So half the homes were under contract in 11 days or fewer. That's nearly 3 times higher than what we experienced for the first 4 months of the year, where we were sitting at 4 median days on market. So again, waiting a little bit longer to make price reductions because it's taking longer to sell homes. For homes that went under contract this last weekend, it was 36.8% of them made price reductions. And so we're seeing a lot more price reductions rolling around out there. 62% had no change in their price, or they went for the full price offer this last week, or they might have gone for under asking price. I can't quite measure that until the property closes for how much under asking price they were going for. But again, we're looking at about 36.8% of those homes making price reductions, and price reductions have been on a steady rise since Easter weekend. We went from back in January and February where it was only 5 or 6% making price reductions to now we're up to 36.8% making price reductions. Typically in the month of July, we end up seeing about a third of homes make price reductions. So the rate of price reductions right now is higher than what we would typically expect for the month of July. And the size of the price reduction was about 5.7% or about $42,000 off of the original asking price. This is a new trend where I'm seeing more widespread and larger price reductions. Usually when the market shifts, we see more widespread price reductions at smaller amounts because we're chasing the market down. We don't want to cut off too much, but I'm seeing larger price reductions at this point. So again, if you're pricing off of peak comps, you've got to go softer on your pricing by about 5 to 7% right now, or you're going to be faced with making one of these large price reductions up front.
And the interesting psychology right now, though, if you go out into the market 5 to 7% lower, you'll probably have multiple bids, and you'll probably be right back to where the sellers, or maybe not all the way to where they want, but you'll certainly have the opportunity to do
right. And what's interesting is I'm hearing a lot of people are waiting until weekend number 2 to get out there and look at houses rather than looking in weekend number 1 because they want to avoid the multiple offer situation. And I'm hearing that there are still some agents that are making price reductions after the first weekend, and after they make the price reduction after the first weekend, in weekend number 2, then they're in multiple offers because they get down into the sweet spot in the market.
Yes.
And so I've heard that story repeated a couple of different times where people are making those multiple offers in weekend number 2 after a price reduction was made. For the under $500,000 market, again, cooling trend really set in. We had fewer new listings make their way to market, but now we're sitting at 0.7 months worth of inventory, which is up from the 0.1 months worth of inventory that we had back in Super Bowl weekends. Our average daily active count came up by another 10% this last weekend. New listings were down by about 45% this last weekend going into July 4th. Pending transactions fell by about 30%. So again, over these 3-day holiday weekends, we expect to see a big drop off in activity, and that's what we saw this last weekend. The odds of selling dropped down, but not quite as much as it did at all price points. We dropped down to about 70.4% odds of selling. As we went into this last weekend, I expect this number to rebound ever so slightly. We'll probably land at about 74% odds of selling. That's right where we were pre-pandemic levels, sitting at about 70 to 75% odds of selling. And so again, we're back to where we were about 2 years ago in terms of where we were for the odds of selling. We're now sitting at 11.7% of the amount of inventory required to offset demand. So I'm not looking for a market correction in the under $500,000 market. This last weekend, if you put up a new listing, you got about 3.5 showings on that new listing that you put up. We've continued to watch showing activity decline as we go through the summer months. Getting into June, they really started to taper off. So again, we had an early selling season, whereas last year we had a really extended selling season. If you had listed your home at the same point 1 year ago, showings were down by about 70%. So showing activity has really declined just in this last year. 10 showings should yield you an offer. So if you're getting about 3.4 shows per week and it takes 10 showings to go under contract, you're looking at about 3 weeks on the market right now for homes that are under $500,000. And we saw median days on market pop up to 9 for the under $500,000 mark. And that's the highest it's been since we were back here over New Year's Eve weekend. Before that, the last time that we saw 9 median days on market was back here in April of 2020 when we were back in the pandemic, when we were in quarantine actually. And so again, median days on market
actually shocking.
really, yeah. And so looking at this 9 median days on market is what we're looking at right now. That number should pop back down as we go into the next weekend. It'll probably hit about 6 or 7. The rate of price reductions was about 1 out of every 3, or 29.5% of homes that were in this price range made a price reduction that went under contract this last week. And the average price reduction was about 5.5%. And that's been holding pretty steady now for the last 3 or 4 weeks, about a 5.5% price reduction, or about $23,000 off of the original asking price. 500 to $1 million is really where the threshold of our properties sit in Metro Denver. And you could see the cooling trend really settle in. We had fewer new listings that made their way to market. This last week, there were about 50% fewer new listings that made their way to market, but our average daily active count still went up by 11%. And you can see this, our active inventory skyrocketing. This blue line over here is what we've been watching. Month supply of inventory popped up to 1.5. So we're out of multiple offer territory for most properties that are between 500 to $1 million right now. For every one buyer in the market, they have 1.5 homes to choose from. So we've seen that number slow way down. That number is likely to pop back down next weekend to probably about 1.2 or 1.3 months worth of inventory, but it's still going to be out of multiple offer territory where that number is below 1. The pending transaction count fell by about 20% over our holiday weekend. So again, a big dip comes out of the market when we go through these 3-day holiday weekends. The odds of selling ended up falling by about 55.6%. So we ended up seeing that there was about a 7% decrease in the odds of selling going into that 3-day holiday weekend. In this market, we're now up to about 25% of the inventory that we require to offset demand. So that number has been trending closer towards a balanced market, although we're still far from it. We have 75% more to go to get to a balanced market, but the market has definitely eased over the last 2 to 3 months going into summer months. This last weekend, if you put up a new listing, it was about 1.5 shows per weekend. And again, it's taking about 10 showings to go under contract. So that means that you could be on the market probably about 6 to 8 weeks in this particular price range right now. Median days on market stretched out to 12.5. And the last time that we saw that number was back here in November and December of last year over the holidays. So that number really stretched out as we went into Independence Day weekend. The rate of price reductions was 41.5%. So huge amount of price reductions in this price range for units going under contract. This happens to be our most loan dependent section of our market. They're the most sensitive to interest rates. So when interest rates go up, what happens is your pool of potential buyers that can purchase that home really diminishes. And so we end up seeing that there are a lot of price reductions that are made based off of interest rates going up so that they can maintain the integrity of their buyer pool. So again, 41.5% of homes that went under contract this last week made price reductions. And the size of the price reduction was about 5.6% or about $41,000 off of the original asking price. Looking at the $1 to $1.5 million market, we end up seeing a bigger cooling trend that settles in as we go up in price. And in this market, we're now sitting at 2.4 months worth of inventory. So we nearly added a full month worth of inventory just this last weekend in the $1 to $1.5 million range. Now, again, going into this next weekend, the buyer pool will become more active because we're out of that 3-day holiday weekend. That number will come back down, but it probably won't come back down to where it was at the 1.5 prior to Independence Day weekend. It'll probably pop down to about 1.7 to 1.8 months worth of inventory going into this next weekend. Our average daily active count only went up by 6.3%. New listings was about half. So going into 3-day holiday weekends, you can expect to see about half of the new listing activity going in to those 3-day holiday weekends, and pending transaction count tends to fall more at higher price points. It fell by 35.1% going into this last weekend. The odds of selling ended up declining by about 10% this last weekend. So it was 47.1% was the odds of selling. And again, that's still better than what we were looking at pre-pandemic, but it's going to pop back up next weekend, probably up to about 53% odds of selling. Looking at 27% of the market in balance right now. So again, that number has been climbing. That number will start to decline again as we go into the next weekend, where we'll see that number pop back down and we'll trend away from balance. About 1.4 showings on a new property that you put up this last week in the $1 to $1.5 million price point, and it's taking about 15 showings to go under contract. So if you're getting roughly 2 showings per week and it's 15.2, I mean, you could be on the market for as long as 7 weeks in this particular price range. So again, waiting until weekends number 3 or 4 before you make a price reduction to make sure that you get enough people through that house before you warrant a price reduction. Median days on market popped up to 14.5%. And that was where we were back in the winter months last year. And so again, it's really slowed down in this particular price range as well. The rate of price reductions was 35.4% of the homes that went under contract last week made a price reduction. And the average price reduction was about 6.2%, which is down from the previous weeks where we were seeing a 9 to a 10% price reduction, but it's still about $80,000 off of the original asking price is what we're seeing for for homes between 1 to 1.5 million. In the 1.5 to $2 million price range, again, the cooling trend really settles in. We start to see more blue cells coming in, and now we're sitting at 1.9 months worth of inventory. So again, for every one buyer in the market, they have roughly 2 homes to choose from. So buyers have choices now in this market, whereas they didn't have choices back here in January and February when our month supply of inventory was down to 0.5 months worth of inventory. Looking at our average daily active count, it came up by 11.1%. So our inventory continues to stack up in this particular price range. Our pending transactions actually went up in this particular price range this last week. It went up by about 30%. We put about 26 units under contract last week for between 1.5 to $2 million. The odds of selling only declined slightly, was about 48% odds of selling, which is still better by about 5 to 6% from where we were pre-pandemic levels. So this market is still a little bit hotter than where we were pre-pandemic. In this market, we only have 15.5% of the inventory required to offset demand. So this market is faring a little bit better in terms of being a seller's market than lower price points are. We're getting about 1.3 shows per property between 1.5 to $2 million, which is down week over week by about 41.6%. So a lot fewer showings over this 3-day holiday weekend, and about 10 showings to go under contract. So again, you could be on the market as long as 10 weeks looking at this price range. We popped up to 13 median days on market, which is where we were back in December of last year. And so again, we're looking more like winter months when we are looking at this last week worth of activity. Price reductions was about 36%, or 1 out of every 3 homes made a price reduction. And the size of the price reduction was about 9.4%, or $178,000 off of the original asking price. So some pretty significant price reductions.
That's a nice sale tag
that are happening over those 3-day holiday weekends. And so again, don't list over 3-day holiday weekends. Don't make price reductions over 3-day holiday weekends, because you're not sure that you're going to get enough buyer traction through those properties to get those under contract. We end up seeing the rate of negotiation going up over these 3-day holiday weekends, where offers are going in for less than asking price more often, and seller concessions are being granted over these 3-day holiday weekends than what we see in other weekends on the market. And so again, avoid those 3-day holiday weekends. Buyers, it's a great time to be out.
I was going to say, my buyers need to get out.
Buyers are really great over 3-day holiday weekends. We'll start to see similar dips in the market in activity as we get into August, when kids start to go back to school, and that will be district by district for when kids go back to school. But then again, Labor Day weekend is our next 3-day holiday weekend. It has similar chunks taken out of it as we go into that particular holiday weekend as well. So again, avoid those weekends when you're getting ready to list. Let's see, we've got a couple of questions that are coming in here, so we'll go ahead and answer those in the chat window. Go for a slip and slide in your garden. I've got one, but I need an air compressor in order to get it blown up. And so funny story, side note, I blew a fuse in my garage, and I didn't know about it for 10 days. And the fuse that blew controlled my sprinklers and my freezer. And so I called a freezer appearance repair guy, because I thought that my freezer blew. And then all of a sudden my yard started to look like garbage. And I went to go check on the sprinkler system, and there's no power to it. So I went and checked the fuse box, and it's like, oh shoot, I blew a fuse. And now my yard, my beautiful grass that I'm a grass hole.
And
like I have a
trying to do
lawn.
the slip and slide, or
no,
what?
I didn't blow it during the slip and slide. I think it blew during one of the really hot days when my freezer was running extra hot.
Yes.
But it blew, and now my yard looks like garbage. So it's not a soft, cushy yard to go out and do a slip and slide. But maybe I'll go ahead and do that, and I'll go buy an air compressor this weekend or something, just a little handy one.
We got a power washer this last weekend. I don't know how we've gone through life without one.
I love my power washer.
It was fantastic.
It is so satisfying. My leaf blower and my power washer are my 2 favorite power tools, for sure. We got some Q&A. Even after adjusting the price 5 to 7% less, if no multiple offers, buyers are offering even less than offer price. Started at $730, adjusted to $695, offer at $685, countered at $690. And so again, we're seeing that happen in the market. This definitely has been a market shift, and so it's time to really start advising your sellers a little bit differently in the market. And you've got to go softer on your pricing strategy. You can't shoot for the moon right now and expect everything to go multiple offers. It's just not likely. We've seen a significant decline in our buyer pool, and we've got a lot more inventory in our market. And again, this is the market we've been praying for.
We've been wanting this
for 2 years.
Yes,
for 2 years we've wanted this, and so again, enjoy it.
Yeah.
enjoy it, but it, again, understand that it changes the way that you've got to run your market.
So we're going to go ahead and jump into the second half. We're going to talk about what is happening with the Fed, with the economy, with the slowdown. Are we in a recession? I mean, obviously, until it is called, we don't know. We'll hear more about that. In fact, you don't hear about the second quarter for another couple of weeks. So we're, here we are, started July. It doesn't happen immediately. It's going to happen a couple of weeks from now, but we will start to see the first look. In fact, the first look for the second quarter GDP comes out right after the next Fed meeting. And we're expecting 0.75% increase on the Fed rate. It would have been interesting if those had been flip-flop. Would they have changed anything if they saw the GDP decline? But we won't, and then we won't see it called a recession for some period of time after that. And remember, the definition of a recession has recently been expanded. We all go off of the Cliff Notes version of the 2 consecutive quarters of GDP decline. But this year, like I said when we started, we've got like 2 conflicting bits of information that have never really seen the light of day before. We've never had a recession when we've had increased consumer spending and jobs. Yet we've never had 2 consecutive quarters of GDP decline and not had a recession. So which one's going to win when they finally call it? Ultimately, doesn't matter. Doesn't matter if it's currently called and is a recession or if we're heading into a recession. I know we've all felt the losses in the stock market. We've all felt the losses in our cryptocurrency, but where we're not feeling the losses is in our homes. And yes, some sellers are feeling that little bit of pullback where they have to drop 5 to 7%, but 5 to 7% after the last 2 years of double-digit appreciation, is that really loss or is that expectation? Are we setting the right expectations for this current market? They can't talk to their seller or their neighbor and talk to what they sold their house for last month, but realistically, what's this market requiring? So let's talk a little bit about what the market is requiring and what's going on. So I'm going to share my screen and we'll get started. Let me just do this. All right. So as we jump into what's happening, I said that I was going to hop in for a hot minute on inventory to jump onto what Megan has been talking about. It's the extremes. I'm going to show it in a minute on the interest rates as well. It's this massive jump that we've been seeing nationally. This isn't just happening here. We are seeing the continued increase in inventory nationwide. In fact, the available inventory this past week was 7% nationwide. Typically, as we know here, we see this massive drop off after July 4th. You talk about it all the time. Mm-hmm. And if you look at these past humps as far as the cycle goes nationally, you see and expect the same thing. But the manner in which it went up, now it very well could be that nationwide we see the same drop off after July 4th that we're kind of expecting here, right? As more inventory comes online and buyers aren't grilling. Right. But it's not just us. Right. So really, it's a decision on what are our buyers feeling here in Colorado? What are the buyers feeling nationwide based on the interest rates? And are they moving about the country due to affordability? Now, certainly, DMAR is also feeling it. DMAR's report just came out this week. I'm sure you guys got that email if you're a member of DMAR. But what I found super interesting about the report as it came out was, although we jumped almost double from last year and 66% from last month, it's not the new listings. As Megan said, it's the demand, right? Pending and close were down. So I wanted to jump into that because it's not just because we have more inventory coming. The market is just sitting there longer, and 7 weeks is okay to be listed before that house sells. So we have been seeing, and I kind of marked it since the beginning of the year, we have been seeing a drop. So we've been seeing the drop off of mortgage purchase applications. That's what this is. And if I go across, we are still down compared to the last couple of years. We had accelerated demand, and we knew that based on those reduced interest rates. When you have artificially low interest rates like 2.625, you're going to have more demand than you expected, or is even natural, because people are buying more than one home, or people that weren't ready yet are jumping in because they don't want to miss out. So we were seeing the drop off as interest rates started to increase. But interestingly enough, we're actually above where we started in June. Given the erratic behavior of the 10-year and the 30-year fixed, to see this was actually pretty good. So starting at the beginning of the month to the end of the month, we were actually up in inventory. We were up 17% when I put out the market trends update video. Now, because the mortgage purchase applications just came out again, that's dropped just slightly, as you can see. And so now we're up 11% for the entire month of June, which had 5 weeks in it. So still a strong month as months go. So I do realize that we're going to have this drop off of demand as the summer comes and summer vacations and then the fall when school starts. But all things considered, I'm looking at this going, okay, yes, demand is down, but it's still here. The homes are still going to sell if they're priced right and staged right. So it's a matter of being strategic as a listing agent, and it's a matter of being proactive and really taking advantage of this market with a little less demand for our buyers, especially our first-time home buyers who really could not compete for the last 2 years. They got shut out and continue to rent. Here's your opportunity because that is dropping. Now, when I look at the interest rates, I drew this line right here. This is where, so the interest rates have already started to go back up again. And I'm going to talk about that here in a minute, but they pop back up again to 5.625. They were at 5.5 when we ended the month of June. And that's really where they started the month of June. They started the month of June at 5.49 and they ended it at 5.5. And in the middle of June, you had a mess. You had a massive mess of interest rates between the consumer price index and, of course, the PCE, which is the Fed's preferred measure of inflation. So both of those inflationary numbers came out during this time. Now, the CPI is coming out again next week. So we will be watching for that as well and what it does to the market. So this same thing happened. This is a little bit harder to read. It's the 10-year treasury, but this is what I'm watching. So the 30-year fixed works off of the 10-year treasury. I listened to somebody else on a podcast talking about the fact that it's kind of like a dog on a leash. It's going to move a little bit in front of or a little bit behind, but it really can't get off of the leash. Mm-hmm. So these two are always going to kind of work in tandem. And what you see right here is it started to go back up again, but again, it's right back to where it started. We had hit 3.5%. And now we were back down. The 10-year treasury, of course, I was on live Facebook talking about the 10-year treasury had dropped to 2.87. It was a massive win and it was gone in a lick. And it's right back up to just under 3% right now. This morning when I pulled it, it was 2.98. So certainly has gone back to where it was. And then we're going to just continue to see this volatility. I said it when I was talking about it dropping. I'm saying it now that I'm seeing it go back up again. This is not a trend line. The trend line is in the middle. It is volatility, and the volatility will continue until we eventually move into this recession. And this recession, whether you think it started yet or it hasn't started yet, doesn't really matter. It's when we control the inflation, we see inflation start to come down and we see interest rates start to come down to reignite the economy, which will slow down, because that's the definition of the recession, is the slowdown of the economy. Those lower interest rates will propagate that economy heating back up again. So we are seeing some small economy dips. I'm going to show that in a minute too. The other news, which Megan just went through all the price points, we saw Redfin came out with their news headlines that replicated in other publications about the fact that Denver was seeing a 40% price reduction. Now, what does that do when your buyers and your sellers see that? Understanding what the headlines are and being aware of what the headlines your sellers and buyers are reading, are your buyers saying, hey, you know what? This bubble is about to bust, right? That's what they're thinking. You and I totally know that. She's like, whatever. But that's what they're going to think. They're going to think if we're seeing a 40% price reduction today, what is it going to do tomorrow? Should I wait another month? Should I wait until the end of this year? What happens if that busts? So knowing that, yes, we saw price reductions at 40%. And here's what it is at the different price points based on the charts that Megan is showing you. Here's the expectation of where it's going to head after the 4th of July holiday, now that we're into July. So arming yourself with the headlines and then arming yourself with the conversation behind the headlines, right, is how you continue to take that data and move your clients out of fear and into action. Because realistically, we might be seeing a 40% price reduction, but we're barely over 1 month of inventory. So we're giving the buyers more opportunity, but we're still 5% less in inventory than we were in 2020, 36% less than where we were in 2019, and we're 80% less than where we need 6 months of inventory. Perspective. Yes, perspective. So we also headlines talking about migration, and I'm getting conversations about this as well. Questions, can you tell me what the migration numbers are? Of course, a lot of what I rely on is the census, and the census is terribly dated by the time it gets out. LinkedIn will have numbers as far as what they see the migration patterns are. I lean on some folks at NAR talking about where the different migration patterns are headed. But some of the headlines that recently came out were from moving companies talking about where they're just feeling and seeing their data, right? Mm-hmm. And their data is limited to their data, and I get that. But to see U-Haul, Allied, and United all coming out saying that it's either getting really close to flipping, or from their data set it is flipping, that we're seeing more people leaving Colorado than coming in. Now, I'm having a lot of conversations about that. Are we unaffordable? Can people no longer buy here? And there are some neighborhoods where they can't. Mm-hmm. Like Cherry Hills is getting athletes and billionaires at this point. But there are areas like Westminster and Aurora and many areas where people can still move and afford to live here. Mm-hmm. You have to really look for those diamonds in the rough, look for the listings that have been on more than a weekend, look for the opportunities, talk about a renovation loan with your buyers, talk about, maybe what are they willing to sacrifice? Do they want to be on a busy street? Most times not. But what does that look like to still take advantage of the opportunities? But affordability is real. It's a conversation we have to know, we can't dismiss, and we have to work with a buyer to talk about where they're at, because we are seeing some of that migration starting to happen where people are selling, taking the equity that they've gained here in Colorado and moving to other states where they can make that money go further, whether it's a pool in the backyard or more bedrooms or a better school district. So they're definitely taking advantage of that right now. But the population is still going to present continued strength of demand. I mean, we have a problem that will continue, this inventory issue. I mean, the extreme by which it's going up is an extreme, and extremes scare people. But it's somewhat right sizing from the last 2 years, mm-hmm. and heading back towards whatever this new normal is. But the demand is unequivocal. It is still there. You can't debate it. The birth rates happened 33 years ago, but can that demand afford to buy a home? That's the question. And can they afford to buy a home here in Colorado? What you're going to see in Colorado, we're still going to continue to have inventory issues, because those people that have owned homes more than even the last couple of years, if they bought a home 5-10 years ago, they're not really ready to move. When you have 62% of all homes with a mortgage, the rest 38% are owned free and clear, and of those with a mortgage, 75% have a 4% interest rate or lower, I'm kind of rate locked, mm-hmm. right? My tenure is going to go up. My home ownership tenure is going to continue to increase. I'm going to stay put because I can't even afford to take that equity and buy again. And we are seeing reverse mortgages increase. So we're seeing the baby boomers are aging in place. And of course, we know the builders can't keep up. This will continue to be a story, regardless of if we continue to see a little bit of a pop in inventory right now. Mm-hmm. 1 month is not a balanced market.
No.
1 month is not a balanced market.
It's still considered to be an extreme seller's market. It's just less extreme than what we experienced back in January and February.
But the sellers don't know that. No. It doesn't seem like, right?
No.
So it is setting expectations and making sure that we're correcting perspective. So what else did we see go on in the economy right now? So the jobless claims just came out this morning, and they came out 4,000 higher. So we'd actually been seeing where the jobless claims were coming out lower, where we still had a very strong job economy. Now we actually saw the jobless claims tick up. In fact, I was just telling Megan before we started that we saw another lender, Sprout, close their doors. They did a company-wide call and shut immediately. We are seeing that, but the biggest companies that are losing employees are lenders, real estate companies, and technology, high technology. A lot of the other industries haven't been feeling it yet, but we know that this is an indication of when we start seeing an uptick in unemployment, we are in the recession. That has been proven time and time again. Mm-hmm. So we're starting to see this tick up. The JOLT report also came out with how many job openings there are. It had dropped from 11.7 to 11.3. So really what that means is some jobs have been filled, but other jobs have been closed. So as companies are weathering out whatever this storm looks like and how recession is going to hit them, they have closed some of those job openings and just kind of trying to figure out what the rest of this year looks like. So that is yet just another indicator that we're heading there. Tomorrow, we're going to see the BLS unemployment numbers and the job report come out. Usually the paychecks numbers came out this morning, and I could have talked about that, but they're revamping that report and pulling it back out at the end of August. Not Fed chair, but Fed member Bostic is also talking tomorrow on CNBC. So we'll be watching what he's saying the Fed is doing and thinking now. But also yesterday, the Fed Reserve meeting minutes came out. Now, of course, this is dated because we've already been talking about the fact that at that meeting, which happened right after the CPI numbers came out, they jumped and they were expected to do 0.5%. They jumped it up to 0.75%. So, of course, the slide deck for both Megan and myself, we send this out later. I don't need to read all of this, but really what it highlights is the fact that the Fed did think at the last meeting, and we're going to hear from Bostic tomorrow, are they continuing to think the same thing based on the PCE numbers that came out after the last Fed meeting and after the CPI? But they're saying that the risks of the outlook for the economic growth are skewed to the downside, that they're still expecting the GDP to go down. They're still expecting that the recession is going to happen. Remember last time I was talking about the fact that Powell had said that, did I ever say that we could do this without pain? I don't remember. Yep, senior moment. He did say that. But now they're saying that, yes, we are expecting that GDP is going to start to go negative. The Atlanta Fed tracks this on a regular basis. So they actually have a running tally of where they predict the GDP to be for the second quarter. And they've been running it since the end of the first quarter. And when I grabbed this number for the market trends report, it was at -1, and it had slowly worked its way from 0 to -1, given all the reports. Well, then it just dropped significantly from -1 to -2.1% negative, because we already have a negative for first quarter. Now they're expecting the negative for the second quarter based on the information that we just got from the ISM. So I want to share that. So the ISM is talking about manufacturing. There's an ISM services and a ISM manufacturing. So this is really kind of before the consumer retail numbers that would come out, or the consumer spending numbers that would come out, because that's going to be at the end of the supply chain. This is before that as we lead up to it. So some of the numbers at first, we actually saw our interest rates go up when these numbers came out because business activity and production was up 2 percentage points. That's really strong. But overall, the market or the report was not strong. So the entire services number went down just slightly. New orders were down. We see prices. This is really good news for the expectation of where inflation is going, because prices were down 2%, but they're still having employment challenges. Those are significant. Even though we have all these job openings, we don't have enough people to fill all those job openings. They're still feeling that, and their backlog is up 8.5%. So where we have a ton of inventory and certain things that we saw major sales going on this weekend. Did you see all the sales?
I did. I was looking at Best Buy stuff.
Did you buy anything?
I didn't.
I didn't either.
I have a hard time pulling the trigger when it comes to big purchases.
Yes.
Oh, I get so nervous about it.
I just don't want to go shop for it.
No.
It's like if somebody, I just need to Amazon even the big stuff.
Yeah.
I just need it delivered to my house. So while we were seeing inventory increase on certain things, because we talked about Walmart and Target and Amazon all having growing inventory, we're seeing inventory of other things like car sales still backlogged. We're seeing some services still backlogged. We're seeing some manufacturers still backlogged. So based on this, the Atlanta Fed is now saying a -2.1%. And I go back to the conversation. It's really hard to say that we're not in a recession when you have 2 consecutive quarters of negative GDP decline. It's just really hard to say that we are when you continue to have consumer spending, especially in the first quarter, and you had strong employment. But we're seeing all of these things now start to slow down. We're seeing consumer sentiment down. We're seeing spending down. We're seeing now the expectation of GDP down. We're seeing the services and manufacturing down. So all of these things, including inflation, is starting to slightly come down. Now, that'll be really told and a really good indicator when we see the CPI numbers come out next week. So in all of this, the Fed is saying that we're expecting a 50 to 75, probably 75 bip increase at this next meeting later this month. But they're also now talking actively about the continuation of reducing the size of the balance sheet, or quantitative tightening. That quantitative tightening, I bring that up right now, even though they're not pushing it forward abruptly. I'm bringing it up because that will start to push up interest rates. It's what it does. As it pushes up interest rates, we're going to continue to see the volatility. Anybody waiting on the sidelines for the bubble to burst or lower interest rates to come is going to miss out on increased prices and possibly even increased interest rates until we get there. By the time we get there, as we continue to talk about, we are going to have a frenzy of buyer demand based on people who were pent up. They finally see that the prices not are dipping, but they see the interest rates have dipped. They're going to want to buy on the dips. And now you're going to have another buyer frenzy. Now, I don't know exactly how that's going to play out, but it doesn't even feel good to me. So if that happens and we still have not made up for the lack of inventory, and we see interest rates decline, and we see buyer intensity increase, we are going to see it harder, especially for those first-time home buyers. That's why talking to all first-time home buyers, getting them in now, locking down that purchase price, and allowing them to refinance when the time happens is the right conversation, the conversation that we need to keep having. Because I know that it's becoming unaffordable. You can't not say that it's becoming unaffordable, but is it any less affordable than renting long-term? Maybe today it is, but that rent is continuing to go up. In fact, it's slowing down like everything else, right? As things slow down and adjust a little bit, the big ones up here are Zillow and the apartment list. They're still high. They're still increasing. They're just increasing more slowly, right? But I don't know that more slowly is from 17 to 15. That doesn't feel very much slower. So it's still high. You're still talking about almost 15% price increases year over year. What's really interesting is these down here. These are the numbers that owners equivalent of rent. Like if I own a home and you ask me how much would I rent my home for, if I were to rent it, that's what the owner's equivalent of rent means. Such a backward number, but that's one of the numbers that impacts inflation. So these are still going up. And so that really tells the fact that yes, inflation on some of the wholesale numbers is starting to soften slightly. We still have some big numbers called homeownership and renting that's increasing, that's impacting inflation to kind of hold some of those numbers up higher and maybe even some of them more permanently. But our conversations have to be real and they have to be on point. This education has to lead towards, and the learning lead towards action, right? Just not more absorption of information. So how do we help more people get into home ownership? I show this chart and I wish I could find this chart updated. It's not. This is from the pre-pandemic. I showed this chart back at an economic summit for DMAR a couple of years ago, showing that the net wealth of those 80%ers of Americans, their net wealth was comprised mostly 62% within their singular primary home. Now that had bounced up to 64% by 2019. I don't have a number for 2020 or 2021, but this is what kills me. The housing value gap between households earning more than 200% of their area's median income and the other homeowners continues to widen. In 2010, high-income homeowners held 28% of all the U.S. housing wealth. By 2020, that figure rose to 42%. So the 200% of the area median income individuals own 43%, and this was before the massive increase of wealth. So when we see this, these numbers are only going to be bigger and this gap only wider. Here from 2010 to 2020, 71% of the increase in housing wealth was gained by the high income households. This is our job. This is why I get up every single morning, not to do another transaction. I know that's not why you do it. How are we educating? How are we serving you, our agents? And how are we helping you to serve your clients? How are you communicating them in a way to get past the fear and understand that locking in a mortgage today is so supportive of getting out of rent, even when it costs a little bit more? It's the wealth story. How are we changing our clients' wealth story? Because we have the biggest impact on their lives, because we access the biggest percentage of their net wealth. We have the opportunity to help them achieve that kind of financial freedom that only real estate can do. And I think this is the time. It's more important now than it ever has been before, because they want to shelter in. They want to stay back and wait for the bubble to burst. Taking all the information that Megan shares and I share is the way to help them to get past the fear and get into that space. So here's a couple of things that are happening, two real quick things, and then we're going to shut down and see if we have any questions. Freddie Mac, Fannie Mae had already been doing this. So this isn't new news. It's just now also available to Freddie Mac. Freddie Mac is now accepting rent payments history to help approve affordability. So this isn't something like I can't take the rent because you're not going to be paying anymore and help like in a debt to income ratio, but I can help you get an approval through an automated underwriting engine. Because if I don't have a lot of other credit, it could be that maybe one bad credit choice makes it so I can't get an approved eligible when I run automated underwriting. This is going to help set up and prop up a buyer's ability to get an approval. So they're doing this, and you can even document it. So if I can plug into the automated underwriting engine through Venmo, PayPal, or Zelle, getting into an account where you're paying the rent payments, or Freddie Mac is also trying to incentivize landlords to report. So if you can talk to your landlord and ask them to report your rent, that will further boost your score and boost your ability to get a loan. So Freddie Mac and Fannie Mae are both doing that. This starts on Sunday for Freddie Mac. And then the medical debts, we've been talking about this. We heard about it a while ago. It's now going live or just went live as of July 1st, that the medical debts is now falling off. So they're going to be removed. If you pay a medical debt now, it usually sits as a paid collection on your credit report. Now it's going to be removed from your credit report as soon as that medical debt is paid. They're also not going to be reported for a singular year. It used to be that they were reported after 6 months. So this is a massive pickup. And then they're only going to be reported if they're over $500. I've seen a ton of medical collections for $40, for $78, for $101. And the borrowers are like, oh my God, that just knocked my score down 20 points. And it was $60. Now they can't do that anymore. They can't report it unless it's over $500. If it's over a year old, and the moment you pay it, it gets wiped out. Make sure now we're back, we're on a waiting list. We are officially, tickets are sold. We only have so much space, but get on the waiting list. We're going to start reaching out to everybody that did RSVP. Megan and I are hosting for Agent Ignite, Mike Sherrard. We're going to be doing our market update both on Zoom and in person at the Columbine Country Club. And make sure to reserve your spot on the waiting list. I'm excited to say that we sold out all the spots on that one, but it is going to be a ton of fun to share that time together. Let's see if we've got anything. It's kind of a quiet group today.
It is a quiet group today. How many people do we have online today?
We had a bunch of people online, a couple hundred. Same. I'm usually sticky as a cart shopper. Yeah,
I know. I like to fill up my cart and then I just like leave it.
And then you leave.
And then I leave it. And then I don't actually buy anything.
Yes. And then somebody asked if the mortgage applications, mortgage applications or refi and purchase. I always look at the purchase applications. When you look at mortgage applications as a whole, it does include refinance. But whenever I try to look at them, I'm looking at the purchase applications.
Awesome.
All right.
Well, that's everything. I think we're going to end a little bit early this year. And so, we're just getting a lot of thank yous for what we do. And we love to do what we do. It's our job to make sure that you're better advising your buyers and sellers. And as always, we hope that if we're able to help you better advise your buyers and sellers, that we'll be able to see you guys at our closing table. So please keep Fairway Independent Mortgage in mind and First American Title in mind for your next upcoming closings. We would love to work with you. We hope that if we're able to help you do your job better, that you'll help us do our jobs better as well. So thank you so much for tuning in today, and we will see you guys next week.
All right. Bye-bye.
Bye, guys.